All right. Welcome back to the Weekly Rebalance. We're on episode number 7 now. Um, moving right along towards the end of the year. So
Yeah,
how's your week been so far, Nick?
it's been busy. We've had some interesting issues with the AWS servers going down to deal with, some fires to put out, but it
Yeah.
was a stressful way to start the week, but all's well now.
Yep. Sounds good. Well, we've got a couple good, interesting topics this week, in my opinion, that are pretty relevant. I know we're going to talk about international markets and their relationship to the U.S. markets and valuations and whatnot. And then we're also going to talk through some yields and rates and how those are affecting mortgages and whatnot. So thinking you want to start off and
Yeah,
get into some of the international conversation?
yeah, let's do it. Let me get my
Sounds good.
little presentation pulled up here.
Sounds good.
All right, perfect. And really, the reasoning for bringing this up, I think we might have touched on it in the past, but earlier this year, we rebalanced into an additional 5% of international holdings. So before this rebalance, our typical stock portfolio was 70% domestic, 30% international, which is still probably above the average US portfolio managers' holdings, international holdings. 30% is probably higher than the average by a little bit. That being said, we saw an attractive market for international stocks, and so rotated into that a little bit more, increased that allocation by 5% to 35% international, 65% domestic. And that's played out well so far this year, and we've been happy with that move. But just wanted to dive into that a little bit more because there's some interesting history here with price returns that maybe is not at the forefront of awareness since it's been a little while since international and emerging have really outperformed compared to US markets.
Yeah, absolutely. Definitely. It's been a long time, but I mean, I've been
Yeah.
doing this since 2015, 2016, and not very many times has the US markets underperformed the international markets.
Yeah,
It's been a long time.
it's been a while, and especially I got started about 3.5 years ago. And really, at the beginning of my time, there was a lot of hesitation to go into international markets, and understandably so, because they underperformed so much over the past 15 years, really. So starting to see a little bit of a shift there, but taking a look at the historical price dynamics between the S&P 500 and international stocks, it was interesting, and I just thought it would be a fun little topic to go over here really quick to start things off. So we'll begin by just looking at the performance from April 2003 through today. And April 2003 is kind of arbitrary. It's really just the funds that I was using to compare this. EEM, the emerging markets exposure, had an inception date in April 2003. So just for convenience, we're gonna start there for the sake of this. But we get some interesting data points starting there as well. So we'll keep on rolling with it. Anyways, over the past 22 years or so, it's more or less what you might expect given what we've seen recently. S&P 500 has returned about 1,000%, a little over 1,000%, performed very well, outpacing emerging markets and international markets over that time period. So followed up by emerging markets at 657%, and then followed by developed markets with 453.5% return there. So that's kind of in line with what I think a lot of people would expect, especially given the past 15 years. Some of the just dynamics that we notice when we talk with advisors, this seems to be what a lot of people kind of anticipate from these markets or what they've come to expect. I think the interesting thing that comes up here is if we go back a little bit further and look at the performance of international stocks versus US stocks, really leading up to the financial crisis in 2007, 2008, you see that international and emerging pretty handily outpaced the S&P 500 over that time period. So April 2003 to October 11th, 2007, Emerging markets were up 391.7%. Now, keep in mind, we've got total return metrics coming in here, so this isn't just price return that we're looking at here. But nonetheless, you see great outperformance from emerging markets, and then followed up by international markets, international developed markets, and then followed by the S&P 500, which returned a 91.27% return over that time period. So it's just important to go back and get that kind of context that there has been periods of time where international and emerging stocks have pretty handily outperformed the S&P 500, and that it hasn't been this way for forever.
Yeah, yeah, exactly. I feel like that's whether you're an advisor, especially the retail investor, it's it's like absent from their mind almost completely for whatever reason that that's even possible. Um, and I think, I don't know. What do you think on so one risk here as an advisor, if you're an advisor and you know this, because I think most advisors would know this, um, or know that there are periods of time where international markets are going to outperform US markets. How do you handle things like, well, for example, the only index that my clients pay attention to is the S&P 500. So, if the S&P underperforms some emerging markets or developed markets index, that's fine. I don't care because at the end of the day, all my client is comparing to is what they see on CNBC or, you know, other, what they're tracking.
Yeah.
Um, I don't know. That's a difficult. What do you think of that?
No, that's definitely a tough, situation to deal with clients, and I haven't had too much of that experience myself. From what I've seen, it's really important at the outset of the relationship. And what I've heard from other advisors too is at the outset of the relationship, being very explicit with what's being targeted here, the kind of dynamics that we're expecting to play out, and why we would do something like allocate to international or emerging. And a lot of the reasoning would be there's periods of outperformance for these, and then also just a diversification standpoint from one, reducing the correlation between assets. So international and emerging stocks don't have the highest correlation with domestic stocks. So that provides some diversification there, but just also geographically providing some diversification in the event that we have something specific to the US. And of course, with contagion and everything like that, that generally does happen to trickle down to other parts of the world economy, but definitely serves to diversify from US markets from a correlation perspective and a geographic perspective.
Yeah.
So it seems to be important to do that kind of education upfront and on an ongoing basis, just reminding people why that is. But that's definitely easier said than done.
Yeah, I agree. I think that that's one of those things that it's an education thing, more than anything else, especially if you're gonna track and talk about performance regularly. And I think that is one of those things that's one way to approach it, and potentially maybe even the best way to approach it is focus more on, instead of comparing yourself to a benchmark, just focus on the planning, focus on asset allocation, focus on risk management, and forget about creating this horse race methodology. But that's one way to approach it. But yeah, definitely a difficult conversation if your clients are paying close attention to those markets and those comparisons, because yeah, you could make a great decision over allocate to international, and that'd be phenomenal. But nobody cares. And then you could have a situation where it's terrible to be invested in U.S. markets and the drawdown's huge, but it's the same as everybody else and
I
same as the
know.
markets that they're watching. So, we're fine.
Exactly.
Anyways,
Exactly. The neighbor's down 30% too. I'm okay with it. That kind of
yeah, the
thing.
neighbor lost 30% too. I'm okay.
Yeah. It's funny too because talking this through, it really just it speaks to two very common behavioral biases when you're looking at finance, and that being availability bias and also just home field bias, or just being comfortable
Yeah,
with the domestic market as opposed to the foreign market. Uh,
right.
just
Pretty common.
on top of that availability bias of, hey, over the past 15 years, the S&P 500 has outperformed a lot of things, most things, pretty much everything except for US growth. So you have that to combat as well. But that is kind of
Yeah.
funny.
But the dynamics are changing a bit.
Yeah, absolutely. And we kind of see that starting to play out here this year. We'll get to that in a minute. This is another thing I wanted to highlight, and this kind of speaks to that availability bias that you might have to confront as an advisor if you're sitting down with a client. So here's the performance of the S&P 500, proxied by SPY, the performance of international emerging markets, proxied by EEM, and international developed markets, proxied by EFA. And you can see here, you've got a pretty big hurdle to overcome because over the past 13 years, well, 18 years, you've got 504% for the S&P 500 compared to 95% for international stocks, international developed, and 54% for emerging markets. So that's a pretty steep little hurdle to overcome there.
Yeah, huge hurdle to overcome.
Very, yep, very true. So can't really blame anyone for being a little bit hesitant for diving back into international markets. Now, we do have some data or price return data starting to swing in our favor here. So this is the performance of those same funds over the year to date. And what we see is we're starting to see that relationship that we saw from 2003 to 2007 pick up again, where emerging is outperforming international developed, which is outperforming the S&P 500. So year to date, up 32.58%. Emerging markets, the EEM fund is up 32.58%. 28.2% for the international developed market and 15.54% for the S&P 500. So starting to see some outperformance from the international markets, and there's a lot of tailwinds that contribute to that. International markets are relatively cheap compared to the US. There was a great study that we saw, I believe it was from JP Morgan, and we kind of replicated the study when we did our market update earlier this year, where they were taking a look at the divergence of PE multiples abroad versus the US. And we've just gotten further and further apart. The US has gotten more and more extended. International markets have become relatively more and more cheap. And we're kind of seeing that bounce back to where international markets are catching up to their historical relationship to the S&P 500. So that's one of the things. We also have some interesting dynamics playing out with the dollar, and I've got some charts on that to follow up here, but definitely has been a good year to be in emerging and international stocks relative to the S&P 500 so far. So we've been happy with that move, but we understand that there is some hesitation there, especially given the past 18 years.
Yeah, absolutely. Totally understandable.
Absolutely. Absolutely. Well, here's just an interesting little chart as well I wanted to highlight. When we're talking about international stocks, specifically as a US investor, it's an important thing to keep an eye on, the US dollar relative to other currencies. So we have the dollar index here, and this tracks the value of the US dollar against a basket of 7 currencies, and they're developed market currencies. They're more commonly traded ones, but it still serves as a good proxy to measure the relative strength of the US dollar to international currencies. And what we see over the past 25 years or so, we're still at elevated levels compared to the average over that same time. Now, it's been pretty volatile. We've had spikes where it's been very valuable. It's come down a decent amount, particularly in 2008, but we're still above the historical average for the past 25 years here. So, still some potential room for the dollar to weaken relative to those other currencies, and that provides some additional return for international stocks being held by US investors, because those international stocks are denominated in foreign currency. So when the US dollar starts to weaken, those foreign currencies appreciate relative to the US dollar and add some additional returns to those international stocks that we additionally like just because they're relatively attractive right now. So
Yeah,
another
absolutely.
important dynamic to take into account there.
Yeah, we had some questions. I've had some questions about that recently. Even as recent as this morning, where questions about how is that affecting, how is the dollar recent weakness in the dollar affecting markets. Sometimes it's, counterintuitive, but you're like you laid it out, Nick. That's exactly right. Especially for U.S. investors, the dollar depreciating, which sounds like a bad thing, right? Yeah, can add to returns in the foreign markets because you're getting this currency appreciation. You're essentially long the foreign currency, whatever that is, and short the US dollar is you're selling the dollar to go buy another currency to buy another stock in another currency. So, anyways, you have certain funds that are hedged for that risk, but most don't hedge it. So, yeah, it's an interesting dynamic. It's a tricky one to follow sometimes, but a meaningful one.
Oh, absolutely. Absolutely. Definitely. I think it's going to provide a tailwind for that international exposure for sure here. And I think
Yeah,
that's
great.
kind of the other thing to keep in mind too here. I feel like sometimes when we talk about international or emerging performing well relative to the US, sometimes I get the sense that there might be some panic, particularly like if you're talking with an end client. Like a great example would be my parents. If I sit down and I'm talking about the market with my parents, and I start to say, oh, I think the international or emerging markets are going to perform relatively well compared to the US, I think there can be some, you know, not hesitation, but people get a little bit nervous when you start thinking about that because at least over recent years, the US has just performed so well that, when they hear you say international markets are going to perform relative to the US, you think that they think, you're suggesting the US market is going to crash or
Yeah,
something along those lines.
which
Bad
is
outcome
not the
for them,
case. Yeah,
which is not the case. Specifically, I think this chart here illustrates that well. 2003 to 2007, international markets outperformed the US pretty handily. And it's
yeah,
not like anyone in the US was particularly hurting at that time. The US wasn't particularly weak or anything like that. It's just international markets outperformed.
yeah. Well, it's also un-American, Nick.
Yeah,
So
well, fair
I
enough.
don't know where your communism is. Your
Hey, hey,
I didn't know you were a communist.
hey.
Your parents might
I
say
drive a
that.
Chevrolet. It's okay. It's okay. I'm doing my
That's funny.
part to support GDP.
Yeah, that's right. Hey, knowing your parents a little bit, they might say that to you.
Yeah, they might. They might.
Funny.
They might. But
Awesome.
yeah,
Well,
interesting little stuff there.
yeah, very cool. Well, yeah, but like it, what was our date? We middle of this year ish. We started increasing the to international, and yeah, been really happy with it so far. Likely to continue. And what we did was not super extreme, right? Like you mentioned, we went from 70% US, 30% international to 65-35, which is in line with the global market cap weighted. If you were just market cap weight the entire globe, you end up very close to that 65-35. So it's not like we've taken this huge bet, but just not something that we wanted to be more neutral than anything else. So um we'll see how that pans out over the coming years, but that was what we ended up doing.
Yep. We've been very
So
happy with that so far. So
yeah,
knock on wood.
absolutely. Well, pivoting a little bit into yields, a little different conversation, talking more about bonds and mortgages now.
I love it.
It's been, what'd you say?
I love it. I love fixed income.
Yeah, I love fixed income too. I think tell me what you think about this, but I feel like fixed income is one of those things. The average return is obviously notably lower than equities, but it's one of those markets where I feel like if you know what you're looking for, know what you're doing, where the value of a really good quality fixed income manager is highlighted. It's extreme, right? Because there's this on the equity side of things. I feel like the markets. I don't know if they're maybe more efficient overall. Less people understand them, or more people understand them more thoroughly compared to fixed income markets. But I feel like the value of a good manager in fixed income is extremely pronounced.
Oh yeah, absolutely. I definitely feel that that's true.
Yeah, well, that's
I mean,
what.
you get a lot of variety with fixed income too. We're not
Yeah,
just
hey,
dealing
totally.
with common stock. I mean, obviously there's other type of equities like preferreds or something along those lines, but with
Right.
stocks, you got floating rate,
Yeah,
fixed
absolutely.
rate.
Mortgage backs,
Yeah, you've
everything.
got options on them.
Mm-hmm. And it really drives a lot of the economy and yeah, it's just interesting. We've been talking a lot recently about equities and talking a lot about the economy. And there's been some interesting, positive news and negative news recently. Some of the negative news about regional banking balance sheets and issues there, obviously concerning the jobs market as a whole, but we've had some positive news as well. Delinquencies on the auto loans side of things have actually peaked and started to come down. Delinquencies in credit cards have peaked and started to come down, and those usually do peak at the end of a recession, and really the beginning of the new business cycle, the early stage business cycle. So, it's interesting. In some ways, some of these metrics and some of these economic data points are indicating that we're almost coming out of a recession, but we didn't have a recession. We did not have a recession, at least the traditional sense. We did not have a recession recently. So very interesting, but interesting to follow what the Fed will do and is doing. We talk, I feel like, a lot about, especially with clients that have had cash on the sidelines, that short-term money market, short-term treasuries, short-term CDs, that yield is just it's going away. It's likely that the Fed gets to a 3% terminal rate or even below that sometime in the next, let's say, 12 to 24 months, which means I think it's very easy to understand for most what that means for them, right? Lower rates on CDs, treasuries, money market, all those conservative investments that investors have piled into. They know that that reduces the yield that they're going to receive there. But one of what I wanted to dive into a little bit this week was just how is that affecting mortgage rates? How is that affecting borrowing? More on the sometimes the opposite of what we do, right? We're talking about investing, but we end up with a lot of advisors that, a lot of clients that, it's really important. The biggest purchase they ever make is their home, and that affects our clients, but it also affects the economy in an extreme way as well. And mortgage rates have significantly, changed over the last year, and they're coming down. Now, one thing to note here is that it's not always related to the short term, the rate set by the Fed. They can move differently, but generally speaking, that is one of the things that the Fed can influence at least a little bit, and we've seen that happen. So mortgage rates have fallen notably over the past year or so, and hopefully that makes houses more affordable and brings on inventory. But just kind of an interesting topic to get into, and I think I was going to quiz you a little bit, Nick.
Okay,
So I
cool.
got some quiz questions for you,
Let's
um,
do it.
related to mortgages. I think it's
Uh-oh.
some of these might be surprising. So, do you know what the current 30-year mortgage rate is? The average?
I don't know off the top of my, I'm gonna say I do look at it every now and then, maybe 6.35%.
Yeah, really close. Somewhere between 6.2 and 6.3% is where we're at.
Okay.
We have fallen the peak was last January. Do you recall what the peak was?
Ooh. We got over 7, right? Just over
Yeah, yeah.
7.
Yeah, the index that I was looking at was 7.4 actually. So
Wow.
really, really high. So fallen a whole, 100 basis points in the last, you know, not even a year actually.
Wow.
So that's definitely affecting the economy and affecting the affordability of houses. What's interesting to me, and I think that's really applicable, is a couple things have happened there. One is inventories are really low, right? Inventories are extremely low because so many people financed during COVID when rates were 3% or 3.5% or 4% or whatever. They were significantly lower than where we're at. And, people that bought homes a lot of people still did buy homes in that higher rate period. And we were at 7.4. So coming down a full percentage point, I think it's very likely that we get down even below 6 as the average somewhere in the next 18 months. Very, very possible. It's going to create some type of refinancing boom, in my opinion. Very, very likely because there's still a number of houses that were purchased over the last year, especially new builds that were purchased in the last, couple of years that aren't financed at 3.5%. So, lower interest rates overall could increase the inventory and create some nuances here in the market. I'm curious. So, quiz question number two: what do you think the projected refinance of mortgage originations is projected at for 2025, and what is it projected to go to in 2026?
Oh my gosh. So of all mortgages, what percentage of them are going to get refinanced?
Yeah, so a good thinking for this year, a better way to ask that is basically, what number of mortgages do you think are the estimate would be eligible for a refinance now that we're floating around 6%?
6% for 2025?
Yeah, in 2025.
Uh, 20%?
It's pretty close. Yeah, 25%, 26% are the estimates, which was surprising to me. I think when I was looking at this, it was a little surprising to me because I was thinking just, yeah, I don't know, a lot of the people, I think it's just a bias for the people that I know. A lot of them have financed at 3% or 2.99, which maybe never happens again, or not for a long time. But they're having just knowing that 25% are actually potentially in a refinancing situation in 2025. It's supposed to actually grow in 2026 to about, I think it was 33%. Let me just look at my
Wow.
notes here, which is surprisingly high in my opinion.
Yeah, I
35%.
guess in 2026, what's their projection for the 30-year mortgage rate?
They were projecting it down in the below 6. Yep.
Okay.
So another 30-ish basis points of dropping there.
Okay.
So
Okay. Yeah.
we'll see what happens there. But it'll be very that was surprising to me that there was that much turnover in financing. I think it really could bring on more inventory because there's such low inventory at the moment. And maybe that little lower interest rate, the cost of housing comes down, and that person that was not going to move now thinks, okay, maybe I can move and can create some turnover. The battle is going to be as that occurs, which is coming from lower interest rates across the board, is what's going to happen with inflation, right? Like these companies that sell paint and um, all the Home Depot, Lowe's, all these companies that sell things like that go into getting a house ready for sale, fixing up a house, all the new building materials. If we have more builds coming, then inflation that's the risk to the economy, in my opinion. And I feel like that is the risk over the next 18 months. The number one risk I feel like is going to be, what does inflation do? But I don't know what you think about
Definitely.
that.
Definitely. I think it's really interesting, and definitely your point about turnover or potentially increasing the attractiveness of moving or making it more feasible for people,
Yeah.
and that potentially introducing some more inventory on the market. Definitely an interesting thing there. I'm
Yeah.
interested to see that for a couple reasons. One, I'm interested because most of the people that are eligible for a refinance when rates get below 6% or right around 6%, I'm wondering, most of those people must have purchased their house relatively recently.
Hmm.
And so I'm wondering how many of those are people are ready to move on to another house, potentially something different, and how that might affect the turnover rate. And then on top of that, I could see it's still contributing additional fuel to the inventory, just from people who have been wanting to move and they desperately, need another bedroom or something like that for a kid, and it's just
Right.
it's too expensive right now to move. So then maybe we get some, more entry level houses on the market as people move to larger houses. Because I know a lot of the scarcity actually comes from, the more entry level segment of the housing market, and I know that pretty firsthand after going through that search a little over a year ago. But
Yeah. Well, you know what's interesting is the I think that there's and we talked about this on a former podcast as well, and I wanted to dive into it a little bit more here because I got some additional data. But I think that a lot of the existing homes are really not eligible for refinancing. What I think will be very interesting is, and there are obviously some, that number of 25% or projected to be 35% was surprising to me. Um, However, I think that there's still this very interesting dynamic where new builds are going to become more and more popular because that is the option, and especially as costs come down and they become more affordable, we should see the market coming, coming online and home builders providing more and more, homes to be built, and that should be more affordable in the coming years if that's the case. But it is interesting. The I looked up some data on what are the average number of listings available in the US and what percentage of those are new constructions versus which ones are existing home numbers. So I was curious. It's not something I look at really very commonly at all. Actually, today was the first time that I've seen these direct data points. But if you had to guess between 2000 and 2019, so pre-COVID, what was the average percentage of listings in the US that were um, new constructions?
let's see, what was the time period again?
2000 pre-COVID, basically
Pre
2000 to
Okay.
2019.
I don't know, 70%?
So
Just a guess.
70% were, so which ones were new constructions?
Oh, new construction. I'll say 30%.
30%, yeah. So it's actually between in that time period, it was 13%. That was the
Wow.
average number of listings that were new constructions. It increased to 16.5% during the pandemic. And it's at a peak, actually a record high right now, which is 33%.
Wow. Yeah,
So
that's where
that's
I
the,
got that 30% from. There's a dashboard I look at every now and then. I swear.
yeah. Yeah, well, it's just interesting that makes sense, right? Especially now, and I think that you're going to see home builders really bring on the inventory. They really are already. Like they have been bringing on. You can see that in that. In fact, I think I even have a chart of that. I should have pulled that up for. Well, I can pull that up now that I asked you the quiz question. The uh um Let me find my slide. There it is. So this is the orange line here is it's been stable for a extremely long period of time at around 87, 88%, and then started to drop during COVID. And the rise of new constructions coming online come in during COVID. It's been really has changed the landscape there quite a bit. And some of those conversations that we've had in the past about how it's actually sometimes it's arguably cheaper to buy a new home than it is than an existing home. It's obviously not true in every market, but it's because of the dynamic here that's changed quite a bit. So very interesting, quite pretty seismic shifts there over the last 5 years or so.
Wow. Yeah. Yeah, absolutely.
So I think for clients at the end of the day and advisors, just the information about that is valuable, and we'll see what happens. It's one of the most important parts of the economy, and I think being knowledgeable about that on the um what on the flip side of investing, right? The borrowing side of things is useful. So hopefully there's some utility in that and some interesting information for everybody.
Yeah, absolutely. Absolutely.
Good.
Just-
Well, that's all I've got for today.
I've
Any
got
any
one quick
closing
thing
thoughts?
for you. Yeah,
Yeah,
I've got a quick thing for you. I want to do some trivia with you.
sounds good.
I've got some trivia for you since you came up with some questions for me. Now, I don't have the exact weights on these because the data provider that I typically use, they only have data going back to 2015. But I'm going to ask you for the top 5 holdings in the S&P 500 on different dates.
Okay.
All right. You don't have to
All
get the
right.
weight or anything. I don't have the weight. I'm certain it was less concentrated than it is now. So
Okay.
we'll just roll with that. But the top 5 holdings within the S&P 500.
Okay.
All right. First date, January 1st, 2000.
2000. Okay. Um, boy, this is hard.
I know.
Top
I don't
five
think
in
I could do
2000. Okay. Um, Johnson and Johnson.
No, not on the list. I'm sure they were up there.
Um, 2000. That was a long time ago. I was
No,
8.
I wasn't born yet.
What'd you say?
I wasn't born yet.
Yeah. Microsoft can't be up
Yeah,
there yet. Microsoft is one?
Microsoft's
Okay.
one of them. Top one.
Mi Microsoft. Um, GE.
Yeah, two.
Okay. Microsoft, GE, 2000 is it an automaker? Ford?
No, no automakers on the
No.
list.
How about a drug company? Pfizer.
No drug companies. I'll give you
No,
that one too.
no drug company. Okay. So it wasn't Pfizer or Lilly or something like that.
No, not at that
Uh,
point. Think like .com bubble kind of.
Amazon?
No, not Amazon yet.
It's too
Not
early.
too early for Amazon.
eBay.
Not eBay. Not eBay. Okay. All right. All right. I'll give you the top 5 and then we'll move on. I've got the next 5 years. I got 2005.
Okay. I got two of them.
Yeah, you did get 2 of them. You got the top 2. I'm impressed. I don't think I would have gotten GE. All right. So top 5, January 1st, 2000, Microsoft,
Okay.
General Electric, Cisco, Intel, ExxonMobil.
Okay. Gotcha. That makes sense.
So not too wild or anything like that, but certainly
No?
I think only one of those overlaps with what we have today. All right,
Yeah, that's true.
let's do
Interesting.
2005.
Okay. January 1st, 2005. So Microsoft,
Yep, you got Microsoft.
um, Amazon?
Not yet, not yet.
Not yet.
You're
Okay.
eager with the Amazon.
I'm eager with Amazon. Mark, is GE still in there?
GE still in there. You've
Okay.
got 2 and 3. Microsoft is 3. General Electric is 2.
Um, okay. Is one of the drug companies, is it Pfizer?
Yep, Pfizer's number 4.
Okay. Is there another drug company?
No, no other drug companies.
So that's 3. Okay. Um,
Let's
2000.
do this. I'll tell you, unless you've got a guess on the top of your
No,
head.
I
All right,
would,
all right. You've got one
out.
oil company and you've got one bank.
Exxon, JP Morgan.
Exxon, Citigroup.
Oh, Citigroup. Okay, interesting.
Citigroup. Yep.
All right.
All right. So that brings us to the final one. I got 2010.
Okay.
All right.
2010. Is Amazon's got to be in here now?
No, no,
No.
no.
Microsoft.
Still eager.
Microsoft.
Yep.
2010. Microsoft. Exxon.
Exxon. Yep. Number one. You got one and two.
Pfizer.
No.
Is there another drug company?
Yeah. There's really
Is it
two.
Lilly?
Well, one. One. It's not
Is it
Lilly. It's not Lilly.
Johnson and Johnson?
It's Johnson Johnson. Number five.
Okay. Um, 2010. Intel.
No, not Intel.
IBM.
Not IBM. It's Apple. Apple was the one you were missing, and then Procter and Gamble. So it was
Okay.
ExxonMobil, Microsoft, Apple, Procter and Gamble, Johnson and Johnson.
Interesting.
Now I don't
Okay.
have the weights on these, and again, because the data provider that I typically use, the reliable data provider that I typically use, did not have these holdings. These should be accurate, but we might want
Yeah.
to verify them with Bloomberg later. He's doing some web scraping with AI for that because you would think a lot of that data is a little bit more available than it actually is.
Yeah. Yeah.
You would think you could just go and they got a list somewhere where
Yeah. Readily
the
available
S&P
information.
500 of all things,
Yeah. You'd think so.
but no. Back to
It's interesting.
2015 is pretty available, but
Yeah.
past that, you need
It's
like a
interesting information. People forget that those names are not constant throughout time.
yeah, absolutely. Yeah, absolutely. Well, you did
Awesome.
very well. I'm impressed. I don't think I would have gotten many of those.
Well, I did my best, but that was fun. I like that. We'll have to continue with the trivia over the coming weeks.
Yes.
Sounds
All
good.
right.
Well, that's all I've got.
Yeah,
Any
I think
closing
that's it.
thoughts?
No, I think that's it.
All right. Sounds good. Bye, everybody. Thanks, Nick.
Bye, everyone.